Sorry, I was doing interpretive dance to the music.
No worries. So welcome everybody to another episode of Environmental Social Justice. We have our returning guest, Mr. Evan Harvey of Nasdaq, one of our favorites. So thank you for coming back, Evan.
Happy to be here. Thanks, Wendy.
Sure thing. And so real quick, last time we spoke, we were talking about environmental social governance, ESG. And it was relatively new. Most people don't really understand the nuances of ESG and why it's so important. So just for the regular viewers, could you just describe very simply what ESG means in the financial sector?
Yeah, I'm going to be confrontational right off the bat because I think that it's not entirely new. It's an idea that's been around in different forms for a couple of generations. It started as sort of impact investing or getting out of particular equities that had problematic moral implications for some investors, getting out of the quote sin stocks. And then it turned into sort of the climate and environmental investment movement in the 1980s. So it's been around, sort of leveraging my investment dollars to create more good in the world is an idea that's been around for a while. Now, ESG as a discipline, ESG as a collection of KPIs and specific data points, that is fairly new. That's over the last 5 to 7 years. And that's really where mainstream investors, large institutional firms have gotten involved saying, among other things, there's a source of return here that we have previously ignored. And there's a sort of a de-risking of my portfolio in terms of companies that may not be built for the long term. So that pressure from large investment houses has really focused attention on the thing that we call ESG, which is an acronym, as you said, meaning environmental, social, and governance. And it's by anyone's measure, hundreds of different specific data points around corporate performance on those measures.
Now, you mentioned KPI. What is that?
I was just about to say that.
Yeah, sorry. I tend to be a little acronym centric. So KPI is a key performance indicator. It's a snapshot of data that I could use to get a quick understanding of a complex issue. So, for example, for a company's environmental performance, their total consumption or their total emissions on carbon is a KPI I could use to sort of compare them to other companies. It's a blunt instrument. It doesn't give me all the information about their environmental responsibility, but it's a way to start comparing apples to apples, specifically as an investor making decisions.
So kind of like the Cliff Notes version.
It is a little bit.
Okay.
Hopefully with a little bit more discipline than, the Cliff Notes version of Moby Dick.
Work with me. You get what I meant.
So one of the things that we have seen with ESG that's happening, what I call unintentional greenwashing. And I know that that's a hot topic because, certain people are trying to do the right thing. They are trying to be more environmentally friendly. They are trying to divest from petroleum industries, but then they don't follow through. And part of that may be because they never had a plan to do so, or part of it is they didn't know how to do so. So some people call it greenwashing. I call it unintentional greenwashing. Some people call it green wishing. How is that developing lately?
Well, I mean, there are many different aspects to the idea of greenwashing. And basically what greenwashing means is using the cover of environmental performance or social performance or governance performance in order to attract investment dollars and other commercial opportunities, but maybe not necessarily executing on those deliverables. Maybe it's essentially a PR cover. Now, I would suggest, and this is totally unscientific, half of what we call greenwashing is probably unintentional. It's probably companies that don't understand the space. They have mislabeling going on. They're misappropriating terms or terminology that they don't fully understand, or the rigor and discipline of how they measure their performance is not great. And it's not up to the performance standard that an investor typically uses for financial measures and financial returns. So that's one kind of greenwashing. Now, as we were talking about before we started, there's certainly another kind of greenwashing, which is where a company intentionally uses the cover of ESG to sell a product and doesn't actually deliver on it, or makes goals and pronouncements. We're in the era now of net zero and zero carbon goals for a lot of companies, publishing when they're going to reach that target. If a company doesn't move, heaven and earth to get to that target and fall short of the goal, is that a greenwashing campaign? A lot of investors are looking at that now as a potential source of disinterest in companies that are sort of inauthentic in their quest to be more sustainable.
Which is probably a very fine line for a corporation, because I'm sure that there are people out there who do this and like, oh, we have the best intentions in the world. We know this is the way it's going to be, blah, 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 blah. And then there's going to be other corporations out there that are just going to be like, we're doing it. We're not doing shit.
We can curse on this show. I have a whole new arsenal of comments.
But I mean, seriously, there's got to be these corporations out there like, this is just what people want to hear, so we're going to do it, and we're going to do a couple of things like not buy a stapler for 2 months, And we're gonna say, but look, we downloaded our footprint because we didn't have a delivery truck deliver a stapler, you know? So it's
Yeah.
like they're gonna, and I know that's,
Well, the fundamental tension, I think, Joel, that's producing that is there's so much commercial opportunity. If you put a green label or an ESG label on a product, on a fund, on an index,
driven. Yeah.
on a sustainability report, there's a certain amount of capital that's just going to flow to you because you've got the right word. I would suggest that there's not necessarily as much investment discipline under that decision making sometimes as there should be. You should be able to look into these companies and see if their performance is objectively valid or if it's somehow hyped up. So, I think the marketplace is driving some of that behavior, and that's why I think it's equal parts intentional and unintentional, because there's so much capital flow. It doesn't take much to sort of find a customer.
I think we're also learning sorry to interrupt, I'm getting into this conversation here, but I think we also learned, like, over the past few years with a lot of the social issues that were happening, that corporations are understanding consumers are a lot more educated, and we have more access to media right now than we ever did before. And it comes at such a breakneck pace that the consumer dollar carries a lot of weight right now. And
Yeah.
it's starting to carry more and more. So as the news comes out where a corporation may not line up with certain values, people are not spending their money there. And I think that's going to start playing more and more, I would imagine, more and more into this. So, like, say a corporation is saying, oh, we're going to go green or carbon neutral by 2025 or whatever it's going to be. And then it comes to light that we're not actually doing anything. People will stop spending their money there.
Once they learn, yes.
Yeah.
But
So I think
it's
that's
the
starting to
beforehand.
happen is as the news breaks faster and we get it on our smartphones, we get it inundated with too much news, but whatever. The the power of the dollar of the consumer is getting greater and greater because people will stop immediately. They will put the brakes on it, and that will impact the valuation of the corporation. So it's going to be an interesting time. Sorry, that was my 2 cents.
I think you're right. And I think the power of social media and the instant availability of data on company performance is definitely driving some of that too. The circles that I run in tend to be more investment decisions rather than consumer decisions, but it's the same thing. What is the measure of authenticity? How do I make my decisions based on data rather than sort of an emotional response to a brand? I think that investors have been moving the needle on ESG for a long time because the theory is, at least, they wouldn't get in this business if there wasn't a return in it. So they're trying to make the most money, and those bets are based on science, not based on feeling.
And the average investor knows without the consumer buying the product, we're not going to invest in this thing. So it kind of does go hand in. They do work together.
Now, real quick, I'm just going to circle back because I try to be all inclusive with people of all backgrounds. So not everybody has an environmental background or a finance background. So when we talk greenwashing, I'll give an example. There's a face cream out there that I personally use and love. And they had an ad campaign saying they're going to sustainable packaging. So no more plastic jars, but aluminum jars that are fully recyclable. In the comment section of that ad, because people were praising it, they said, while supplies last, they'll be going back to plastic when the aluminum runs out. That is your classic example of a PR stunt for greenwashing because it was not a permanent change. So just to give people a little background of what we're talking about, when companies say they're going to do one thing, maybe make a small effort or no effort, and they say, oh, well, just didn't get there. So that's what we're trying to discuss and open about. And Evan, back to you. I know last year NASDAQ had a reporting standard. I believe it was the 30-page document where people could report their ESG. It was very comprehensive, very easy to follow compared to some of the others, which are hundreds of pages of long. Is that still available or been updated?
It is. In fact, we're in the middle of a revision of that right now. So a new version will be out this year. It's something we've done 2 versions of over the last 4 years. And what we did was we essentially cherry picked from a lot of the ESG reporting standards that were out there. So some of them that your audience probably has heard of is GRI and SASB and TCFD and other things. So we basically looked at trying to find a common set, a small number of metrics that all companies across all sectors could report against and sort of start the ball rolling in terms of engaging with their stakeholders on ESG performance. So our list has 30 metrics. It's not complex. It's not difficult to understand. Every metric is put into context of who cares about this? Why do they care about this? How do I measure it? And how do I report it? And if you can answer those 4 questions positively for any of these metrics and it drives your business forward, then I think that we would make a case for reporting it. But this is all in the US entirely voluntary. I know we're going to talk about maybe some guidance coming from the regulator, but so far this has been a market-driven initiative. There are forces on the buy side that want this information and forces on the sell side that want to give the information, so they connect on a common ground. I suspect that the voluntary nature of this might change.
So let's talk about the SEC, the Security Exchange Commission. I know that there's been talk that they will start regulating ESG. Is that moving forward or is that stalled? I personally don't know.
I personally don't know either, but I have suspicions. Since the transition to the Biden administration and the new formation of the SEC with a different kind of outlook on how it regulates capital markets, they have been interested in climate disclosure in particular. They're probably interested in other aspects of ESG performance, but climate in particular. And they put out requests for comment last year and signals that they would be providing some kind of climate reporting guidance for U.S. companies in filings by the end of the year. It didn't happen. We haven't heard much in the last couple of months, other than there may be something forthcoming, but all signals seem to be that there will be some kind of revision or restatement of what the SEC's expectation is on corporate climate reporting, which a subject they really haven't touched since 2010. And part of the reason why the US, many argue, is a little bit behind Europe and other places is because the regulator has been a little bit disengaged on this issue. And so trying to catch up and trying to find the right common sense norm for a reporting basis for companies to talk about how they handle environmental issues is, I think, overdue.
Yeah, I always tell people we took a bit of a nap, but we're awake now and we're coming back to the table. And yes, Europe and most other countries are well ahead of us in their reporting and their follow through. But that being said, there is one corporation that you and I discussed, B Corp. They are a certification program that's out there, and it's primarily mom and pop companies that do their B Corp certifications. Could you explain to the general audience as simply as possible what B Corp is, B Labs does, how people get certified? And they're pretty good.
Yeah, I'm going to be confrontational yet again.
Okay.
There is, by and large, small businesses, but there are notable large examples. We have Allbirds that just listed on Nasdaq, and we have Etsy and others. So brands that people know have formed as a B Corp. So as opposed to what we were talking about earlier with the ESG reporting frameworks, GRI and SASB, a B Corp certification is essentially a reformation of your corporate structure. So it's the way that you structure your business to deliver on formal requirements, the way that you would structure a corporation as a C corporation in Delaware, for example. This is a different corporate form that actually takes into account not only rewarding stakeholders, rewarding shareholders, but actually broadening the company's impact to look at social impact, environmental impact, and to perform at the board level and at the C-suite level against certain objectives that would qualify as, quote, ESG themes. So companies that do this, it's a serious step. It's changing the DNA of the operation of the corporation. It formalizes those deliverables. When you are organized as a B Corp, if you want to maintain that certification, you hit those targets or you lose the certification. So it's not a voluntary thing to get to when you have time or when you have extra money. It is sort of part and parcel of the operation of the company, and it is ultimately the responsibility of the board of directors to deliver on that. So I think it's a rigorous discipline. It hasn't attracted a lot of big companies, I think, because of the dynamic with investors. Investors have questions or concerns about the model, or for whatever reason, it has grown slowly, and it has certainly attracted a lot more attention at the small to medium-sized business side and than at the large end. But it's a rigorous discipline. It's well managed. It's difficult to attain, and it's difficult to maintain. So if people are looking for companies that have a real deep commitment to ESG issues, maybe look at B Corps and the certification model for brands that resonate.
Yeah, go ahead, Joel.
I know, I was just saying, because it's funny what you're basically talking about is changing, for lack of a better way to put it, you're talking about changing the culture of a company. That is not an easy thing to do. I mean, we just saw that through what we went through over the past 2 years with the pandemic and people and work and how we actually approach work now. So trying to change an entire corporation structure and the mentality of how we make money and how we invest the money, that's even a bigger issue. And that's going to be hard to do, very hard.
Yeah. And, when you think about it, B Corp is really shorthand for benefit corporation. So looking at the corporation as an instrument of creating social and environmental benefit beyond just profiteering. So how are they actually able to make money, do business, and also benefit the planet and benefit people? So you're right. It is it's a tremendous cultural shift.
And it's also weird though, because it's like, it's almost like you're not looking at which is what we talk a lot about on the show, is looking at the long-term benefit of a small investment now. And it's like, that is how you get the profits going and you keep going, because as this world has changed and we've seen it, we're living through it. If the corporations aren't doing it now, you may not be here further down the road, or you're going to be further behind from the upstart that's saying, we're going to do this now. So, but again, how do you change the mentality to create the social and environmental benefit and still turn a profit? And you don't want to lose sight of the dollar. It always comes back to the dollar.
It
It
always comes
does.
back to money.
Yeah, and it's really the genesis and sort of the fuel of Nasdaq's continuing intervention in this space and advocacy in this space. We want to build stronger, more resilient long-term companies that list on the exchange and that live in the world that we operate. So this is not necessarily a progressivist stance on our behalf. It's really just trying to create a more robust economic engine for the future. And we believe that this is absolutely vital to do that. Some companies are going to prevail and some are not. And how well suited are you to compete and win in a resource constrained future or a talent constrained future? If you're not making those judgments now and exercising that discipline, it's going to be too late rather soon.
Absolutely. And I'm glad you brought up the resource constrained future, because most people don't realize with climate change, rising sea levels, storm surges, tornadoes, everything of the above, where you get your materials, how you get your supply will change. Your employees will change. Outdoor work will change. So we have to start thinking about that now rather than reacting to it. We have to be proactive. That's just my 2 cents on the marketplace.
Fun in that.
I know. I'm not fun. But so moving with the ESG that we know today, do you have any insight on what our ESG programming may be in the future, near future, of how people are adapting and progressing, or are we kind of feeling a stalemate happening?
Well, I think that's what's happening in the ESG data space is that the data is getting better right now. I mean, up until now, for 10 years, it's been a cavalcade of disparate data elements that have not really aligned very well. They haven't been super comparable. They haven't always used the same methodology. So I think that there's some real effort to harmonize in the space. We heard at COP26, the formation of this International Sustainable Standards Board, which brings together a lot of those ESG reporting frameworks I talked about earlier into sort of one standard, or the theory is they'll create one standard that companies can report to. So a global company can be compared to another global company based on, a single reporting standard. Still a lot of work to be done, but I think that there is sort of a cohesion of the framework space that's happening that will help companies so that they don't have to put out 10 reports. Maybe they can only put out one. I think number two is there's a real push to see more forward-looking data. A lot of the ESG data space has been, what happened last quarter, last year? How are we trending from the last 5 years? And investors in particular are looking for projections. How are we forecasting our performance in a 1.5 degree world or a 2 degree world? How are we forecasting against the rise of cost of goods, Wendy, based on that climate strained environment? So looking at forward-looking metrics to add to that KPI list that we talked about that actually give you more insight into future performance as opposed to ranking and rating the companies based on what they just accomplished in the past. So I think that's a couple of things that are going to happen. I think that, there's certainly a lot of attention on social. The S part of ESG has been traditionally the hardest to measure. I think with the pandemic and with political and social unrest, there's been a lot of effort to try to understand how companies interact with those circles. And the measurements in the S space have gotten better. And I think there'll be even more developments there. So how we put a number on something like human rights, how we put a performance indicator on something like, modern slavery or something like that. So I think we'll see more development there.
I cannot wait for that. Go ahead, Joel.
It's kind of amazing that, there's not, you brought up the fact that we're kind of running a little bit behind here in the US about getting the reporting and the data and, setting the boundaries and the guidelines for what actually is reported. It's kind of mind-boggling to me, especially when you start talking about, modern slavery, and we talk about all these issues that we know are happening in our world, that the countries haven't gotten together to say, like, can we do something to report this? Like, so we're all on the same page here. Like, it's kind of amazing to me that doesn't happen.
There's been some effort to do that through different global institutions. So there's a couple in our industry, FINRA and IOSCO, that manage sort of exchanges or manage securities dealers that are looking at what can exchanges, exchanges are about 100 of them around the world, and they are largely the gateway to public companies for investors. What can they do to sort of create more of a common playing field and a level understanding of what ESG means and how we measure it? But it's really difficult. I mean, you also have a very sort of factionalized government structure in different places. Even within the EU, there are different country codes that you have to report to that are different than the EU code, that are coming from other different things. So there's not for lack of trying, Joel. It's just that it's a really complex regulatory space. And, how long did it take us to get to semi-unified corporate financial reporting, right? Where we have sort of this commonly accepted understanding of accounting principles. It took, 75 or 80 years to get to where we are now based on the last, tremendous crisis, maybe even 100 years. And ESG and sustainability is still relatively young in that life cycle. So there'd be a certain amount of trial and error before we find that common sense norm.
But when they were doing the Paris Climate Accord, was this a part of that talk to just say all the nations that were involved in that to say, let's create a uniform playing field for everybody to know what's going on?
Yes, but it has, there's a lot of skepticism about how well that's been executed since then. And even there's been skepticism about COP26. And, in my own point of view, governments can fix some of this, but it's really the network of business. It's really the network of business that is global and strong enough and rich enough, frankly, to sort of create these connection points. So I think that businesses can't afford to wait on the government regulator to come along and tell them what to do. I think they need to be acting on their own.
Absolutely. I fully support that statement. We need to be proactive and make these changes ourselves. Joel, I'll let you have last word if you have any final questions, because I know that, Evan, your time is so valuable, so I don't want to take
so precious.
Should I invest it? No, Jim.
Yeah.
I have 3,500 suggestions for you.
I'll check my email later. No, jokingly, of course. No, I mean, I think this is a great topic to talk about, and it's really fascinating to hear basically just the reality of how messed up the situation is, but seeing the work that's being done to try to create this. But I do love the fact that there are actual corporations that are really working to do the right thing. It's unfortunate. We all know that there's ones that are just going to say we're doing it, but probably not going to happen
until they're busted, and then their consumer dollars go away.
Yeah. So I think that's going to be I think this is going to be the biggest change that we're going to see over the next few years. I mean, I know a lot of corporations are coming out, especially like in automotive, that are going to be, carbon neutral by X time. And it's like, okay, let's see if this happens. But then you actually hear what their plans are, that they're set up to do that, versus just saying, yeah, we're going to do it. Okay, but you have no goal, you have no intention, you have no plan.
Yeah, and that actually reminds me of a thing I should have added to Wendy's question earlier about the future of ESG, which is the audit and assurance of this sort of sustainability data that companies are pumping into the system. Right now that's been very low threshold. There haven't been a lot of audited or assured reports, third-party audited reports that say they use the right process, they use the right methodology, and this data is valid. I think that's really another next step in terms of normalizing this ESG KPI universe. We need the Big Four and other firms to sort of step in and say we have a process and we have an accepted practice around how we measure climate performance, how we measure social performance, and this company is using the right methodology.
And fortunately, I'm seeing, and this was my gripe last year, more scientists are being hired by these firms to do this. The environmental climatologists that actually know how to measure these things. So I'm very happy with seeing that change, because a year ago that wasn't really happening. So I am very happy with the progress that these corporations are making.
Yeah, you've seen the TCFD protocol. It's science centric. I mean, it really does require an understanding of the shifting dynamics of climate and what that world will be like in order to report against that framework. It's not a tick box exercise. So you need that expertise in house, and a lot of companies are finding they're going wherever they can to find it.
Yeah, it used to be checkbox, just okay, this, and now you have to think about it.
So I do actually have one question for you, and this is about actually investing. So say somebody such as myself, who's not familiar with investing, but they want their dollar to do something good and go towards a corporation. How do you research this?
Well, you could certainly do it passively through indexes and funds. There are lots of ESG themed indexes, carbon-free indexes, things like that you could look at that align with your values. So you could invest simultaneously in hundreds of different equities, for example, that thematically are all contributing to the same outcome, the same impact. That would be the easiest way to go. You could do individual equity research. You can go out there and pick brands that you think are doing this well. You could read their sustainability reports. Some of them are much more readable and understandable than others. But I mean, even that gives you some information about the kinds of companies that you want to support with your investment dollars. You could do it that way too. So, and there's even things you could do in the bond space and other places that you sort of your money, however small it might be, however small a part of the pie, is actually driving a larger global outcome. So there's lots of opportunities here. I would just say, just like we were talking about with greenwashing earlier, do your research, find things that are actually meaningful. Don't assume that the first answer is the best answer, get answer 2 and 3. And I think you'll have a high degree of confidence that you're actually creating some good in the world.
But I do like that you start with something that you believe in. I actually love that aspect.
Absolutely.
I think that's
don't invest in a company because you like their products and you hope that they're good on sustainability. Right. Understand what your values are around sustainability and find the companies that are actually doing great things, because I guarantee you there are hundreds of companies out there doing amazing things that you may not know about, right, and that you might want to support.
Yeah, and read the reports. Make sure when they say that they have, this deadline that by 2050 they're going to be carbon neutral. What's the plan? How are they going to get there? So just making the statement isn't enough anymore. You've got to actually outline how you plan on doing that, and that just requires reading the reports and understanding it. Pardon me?
That just sounds fun.
I know, right?
Some are better
Like-
than others. Trust me, some are better than others.
Yeah, I used to read reports. I was a giant nerd.
What was it in Steel Magnolias? Why am I going to read the book if it's good enough they're going to make it into a movie?
Because you
Just
can nap at home for free.
Just saying.
Sorry, it's a favorite movie. So on that,
I didn't know
Thank
we
you,
were going to
Evan.
get into Steel Magnolias.
Oh,
It's a-
you can always find it out.
There's always room for that.
So thank you, Evan. This has been wonderful as always. Your knowledge is immense, and I thank you. And anytime you want to come back and talk about ESG and further progress,
Or Steel
door is wide
Magnolias.
open. Pardon me?
Steel Magnolias.
Steel
I'll
Magnolias.
brush up. I will definitely brush up.
Well, I get to be 𝑬𝒍𝒂𝒎𝒊𝒏𝒈, so kind of fits. So thank you again, and we will catch you guys next time, and stay tuned. Take care.